Tomorrow morning at 10 a.m., Kevin Warsh walks into a Senate confirmation hearing, and he's bringing a plan that basically defies 40 years of central bank gravity.
Yeah, it's definitely a massive break from the norm.
Right, because he wants to slam on the brakes and hit the gas at the exact same time. I mean, if you're managing capital today, April 20th, 2026, the old rule book is officially dead. Welcome to the deep dive.
This is really the final and honestly the most consequential hurdle to replace Jerome Powell as Fed chair by mid-May. And the market is entirely mispricing the mechanics of what happens next.
Which is exactly why we're doing this, because for a professional investor, you have to understand that this isn't just, another changing of the guard. We are staring down a huge regime shift in global liquidity.
A total regime shift, exactly.
So our mission for this deep dive is to decode Warsh's highly unusual playbook, this policy mix he's calling QT for rate cuts. We want to map out exactly how you should be positioning your portfolio for the volatility coming in May.
And we've compiled a pretty heavy data stack to get through today.
Oh yeah, we've got the latest H4.1 official Fed data to look at the underlying plumbing. Plus, we're taking the temperature of Wall Street with consensus reports from Citadel and Wisdom Tree.
Not to mention dissecting Warsh's own historical stances, which tells us a lot.
Exactly. But before we tear into the mechanics, let's establish who is actually taking the steering wheel here. Give us the 30-second profile on Kevin Warsh, because his history really explains this current kind of paradoxical stance.
Well, Warsh is one of the most heavily scrutinized figures in modern central banking, frankly. He served as a Fed governor from 2006 to 2011.
Right through the financial crisis.
Right through the crisis. And he ultimately resigned because he fundamentally opposed the post-2008 quantitative easing programs. He views heavy-handed central bank intervention as a distortion of free markets.
Right. He hates the money printer.
He absolutely does. I mean, more recently, he called the 2021 to 2022 inflation surge the biggest macro mistake in 45 years. Yeah, placing the blame squarely on the Fed's bloated balance sheet. But, and this is key, he is not just a traditional old-school inflation hawk. Analysts are calling his new approach a hawkish dove hybrid.
Okay, let's pull that apart. He wants to aggressively shrink the balance sheet, so quantitative tightening, or QT while simultaneously cutting interest rates. Like I said, brakes and gas.
Yeah, turning on the air conditioning and the heater at the same time.
Exactly. And I've read the briefings. Warsh operates on this specific mathematical framework, right? He claims that shrinking the Fed's balance sheet by $1 trillion exerts the equivalent tightening force of a 50 basis point rate hike.
That's the central thesis, yes.
But hold on, the bond market is a massive, complex beast. Is that one-to-one ratio an actual proven scientific law? Or is he just, flying blind based on a neat theoretical model?
It is heavily debated. I mean, heavily, which is why the market is so anxious right now. That ratio is based on historical runoff models, but we've never tested it at this sheer speed.
So what's the actual mechanism he's betting on here?
Well, by executing aggressive QT letting maturing bonds roll off the balance sheet without replacing them or even outright selling them, he drains liquidity from the financial system.
The money just vanishes.
Exactly. And that supply-demand shift naturally pushes up long-term interest rates, like the 10-year Treasury yield, which anchors long-term inflation expectations. So that covers his hawkish flank.
Okay, but what about the dovish flank? How does pushing up long-term rates help anyone?
By using QT to keep the long end of the yield curve tight, he believes he creates the necessary economic space to cut short-term policy rates.
Ah, so he lowers the overnight borrowing costs.
Right. The theory is that you get the central bank out of the long-term bond market, restoring actual market discipline while making it cheaper for real private sector businesses to get a short-term loan, to build a factory or finance payroll.
Right, but to really grasp this, we need to look at how that money actually leaves the system. When the Fed doesn't reinvest a maturing Treasury bond, the Treasury Department has to pay the Fed back.
With actual cash.
With cash, yeah. They do that using money collected from taxpayers or by issuing new debt into the private market. That cash leaves the commercial banking sector and just disappears into the Fed's ledger. It's effectively unprinting money.
It is. And if you look at the H4.1 release, the Fed's balance sheet is at roughly $6.71 trillion today. That's down from the $9 trillion peak in 2022.
But Warsh wants to drag this down to $4 trillion, right?
Exactly. $4 trillion. That is a colossal amount of capital to just vacuum out of the system.
Which naturally invites a massive political firestorm. I mean, if you are watching tomorrow's hearing, you will see pressure from two fiercely opposing
Oh,
sides.
absolutely. The politics tomorrow will be intense.
Right, because the Democrats, led by voices like Senator Warren, are demanding delays. They're insisting that prior internal investigations into the Fed be formally closed before moving forward, but then the Republican majority is laser focused on inflation control.
While also, balancing Donald Trump's highly publicized preference for lower interest rates.
Exactly. But honestly, Warsh's hybrid policy actually kind of throws a bone to both sides economically, doesn't it?
It does. The lower policy rates satisfy the political appetite for growth, while the aggressive balance sheet reduction satisfies the demand for structural inflation control.
Okay, but stepping away from the politics and just looking at the pure economics, if you are cutting short-term rates, don't you risk reigniting inflation? We just spent years fighting a brutal inflationary fire.
Right.
Why does Warsh feel safe pouring lighter fluid on short-term rates without triggering another spiral?
His confidence comes entirely from his view on the current technological landscape. Warsh is breaking away from the classic Phillips curve mentality.
The old dogma that says, if the economy is growing rapidly and unemployment is low, it's overheating and you must hike rates.
Precisely. He views artificial intelligence as a structurally disinflationary, once-in-a-lifetime productivity wave.
Meaning that because AI allows companies to produce way more goods and services for
Right.
vastly less money, the fundamental capacity of the economy just expands.
Yeah, you get the massive growth without the price hikes.
Mm.
That is his core thesis. The old rules of overheating simply don't apply if the economy's speed limit has been permanently raised by technology.
Okay, I understand the theory, but if you're a professional investor looking at your screen right now, this policy mix creates a glaring paradox, specifically for tech valuations.
Oh, the multiple compression issue.
Right, because the consensus reports Project Warsh's QT will push up the 10-year Treasury yield by 20 to 50 basis points. You know that when the 10-year yield goes up, the discount rate we use in our discounted cash flow models goes up.
Exactly.
If you can get a better guaranteed risk-free return on a Treasury bond, you demand a much higher premium to hold a risky tech stock. Doesn't that mathematical reality just put immense pressure on high PE ratios? Like, aren't we staring down an imminent severe correction in the NASDAQ?
That is the primary friction point the market is trying to price in this week. A higher discount rate heavily impacts the valuations of high-growth, AI-driven tech stocks in the short term, causing what we call multiple compression.
The PE multiple just shrinks.
It shrinks because those future earnings are worth less in today's dollars. But before we forecast a complete NASDAQ crash, we have to look at the other side of Warsh's equation.
The lower short-term rates.
Correct. The initial valuation hit from the rising 10-year yield is counterbalanced by the structural earnings growth fueled by those cheaper short-term loans.
Interesting.
Lower overnight borrowing costs directly support corporate bottom lines. More importantly, they finance the massive capital expenditures required to build out AI data centers and infrastructure.
Okay, so if you compare the resilience of the AI sector against traditional valuation benchmarks during past liquidity tightening cycles, AI tech actually has a unique buffer.
Exactly. The multiple shrinks, yes, but the actual earnings per share, the denominator in the PE ratio, grows so aggressively that it offsets the valuation damage over the medium term.
So the pie itself is getting bigger, even if you're paying slightly less for each slice. But let's follow the logical chain here. We've been talking about the stock market, but to me, equity valuations are just the tip of the iceberg. The real existential threat of pulling trillions out of the balance sheet isn't a tech stock taking a 5% haircut.
No, it's the plumbing.
It's the gears of the banking system physically locking up. Let's talk about the plumbing.
We have to look at the scarce reserves framework.
Yeah.
Commercial banks keep reserves at the Fed to settle transactions with each other. Economists estimate the critical threshold for the U.S. financial system is around $3 trillion in reserves.
And when Warsh aggressively unprints money through QT, those reserves dry up. Think of those reserves as the oil in the global financial engine.
Right.
You don't really think about it when you're driving until the dipstick reads dry. And if we hit that $3 trillion mark, the engine seizes.
That is the danger.
Yeah.
If reserves become too scarce, banks start hoarding cash to protect themselves. Suddenly, the overnight repo market, where trillions of dollars are lent between institutions just to keep the lights on, freezes completely.
And the cost of overnight borrowing spikes violently.
Violently. We saw a dress rehearsal for this during the 2018 to 2019 balance sheet reduction. By September 2019, early QT signals caused massive market tremors and repo rates skyrocketed.
I remember that. The Fed had to jump in.
Right, so economists are deeply concerned that Warsh's aggressive targets could lead the Fed to accidentally drain too much liquidity too fast, losing control of the federal funds rate altogether.
And a plumbing issue in New York doesn't stay in New York. If you are managing a global portfolio, let's say you are heavily allocated in Australian equity markets, how does a policy shift in DC hit your backyard in Sydney?
Well, it basically transmits globally through the US dollar. When Warsh pushes up long-term US Treasury yields, those higher yields act like a giant magnet for global capital.
Because everyone wants that yield.
Exactly. Institutional investors sell foreign assets to buy US bonds because the risk-free return is suddenly highly attractive. But to buy those bonds, they must buy US dollars.
Driving up the value of the dollar. The consensus reports from Citadel project a 1 to 3% bump in the dollar in the very short term.
And a surging dollar effectively drains global liquidity. For Australian equity markets, or any globally linked asset class, capital flows out toward higher long-end US yields.
Oh, wow.
Yeah, it creates currency-driven volatility and tightening financial conditions locally. An Australian mining company or an AI startup in Melbourne suddenly faces a higher hurdle to raise capital simply because the U.S. Federal Reserve decided to shrink its balance sheet.
It's all incredibly interconnected. So knowing all these mechanics, the tension between QT and rate cuts, the NASDAQ multiple compression, the risk of the financial engine running out of oil,
Oh.
and the global dollar squeezing, how do you actually trade this?
Right, the actionable part.
Yeah, let's spend some serious time on the calendar because we are entering what the institutional desks are calling the transition window.
The timeline over the next 90 days is crucial. Tomorrow, April 21st, is the confirmation hearing. That is milestone 1. The market will basically algorithmic trade every single syllable Warsh utters about the speed of his balance sheet runoff compared to his willingness to cut rates.
And from there, we move into mid-May.
Right, which brings the actual inauguration of Warsh as chair.
And that May window is where the real danger lies. The market absolutely despises regime changes because the new rules haven't been stress tested. Then milestone 3 is June, the first FOMC meeting that reflects his actual lived policy.
Yeah.
So for that May danger zone, what is the actual risk profile? Let's quantify the probabilities of a pullback.
Okay, based on institutional modeling, the base case, which is a 60 to 70% probability, is that Warsh delivers a balanced hearing tomorrow.
Meaning what, exactly?
He talks tough on shrinking the balance sheet, but promises to be heavily data dependent so he doesn't break the plumbing. That likely triggers a 3 to 6% market chop,
Yeah.
just standard digestion of a new reality.
So a bumpy month, but not the end of the world. But if you're managing risk, you have to look at the bear case.
You do. The bear case, sitting at a 20 to 30% probability, is that Warsh signals a ruthlessly hawkish approach to QT, totally dismissing the warning signs of the 2018 repo crisis.
Just blinders on.
Yeah, he insists on hitting that $4 trillion balance sheet target, come hell or high water. That triggers a rapid spike in the 10-year yield and forces a sharper 5 to 8% market pullback.
Wow.
I should add, though, a systemic crash, something south of 10%, is highly unlikely at less than a 20% probability, assuming no external macroeconomic shocks.
Okay, a 5 to 8% pullback is significant. Not quite time to move to an underground bunker and buy gold, but definitely time to check your blind spots. If you're staring down that bear case scenario for May, what are the specific portfolio adjustments you should be executing today?
You need to implement a barbell strategy to build a shock absorber. On the short-term side of the barbell, rotate capital into value and cyclical stocks.
Because they're less sensitive to the rates.
Exactly. They are far less sensitive to the QT-induced yield spikes. When the 10-year yield jumps, a traditional value stock doesn't suffer the extreme multiple compression that high-growth tech does. They act as your ballast, while the market throws a tantrum over the new QT pace.
Makes sense. And the other side of the barbell, the medium to long term.
Looking 6 to 12 months out, you must maintain your exposure to AI and earnings-driven tech. I mean, the medium-term consensus from both Citadel and WisdomTree is overwhelmingly bullish. They are projecting an S&P target of 8,200 or higher.
Let me push back on that because an 8,200 target seems aggressively optimistic if we are simultaneously pulling trillions of dollars out of the banking system. Why are they so bullish in the face of massive liquidity withdrawal?
Because of the short-term rate cuts and the AI productivity boom we talked about. The institutional consensus believes that cheaper borrowing costs will supercharge corporate earnings much faster than QT can drag down the valuation multiples.
Ah, I see.
Yeah, the risk of missing that historic AI-driven rally, basically the FOMO risk, far outweighs the risk of suffering a 5 to 8% short-term pullback in May. You do not want to be entirely sitting in cash when those AI productivity metrics start showing up on balance sheets.
So you hold the line on the structural tech growth, but you pad the portfolio with value stocks right now to survive the May transition. I like that framework. For anyone sitting at their terminal tomorrow morning during the actual hearing, what are the specific indicators that will tell you whether we are heading for the base case chop or the bear case pullback?
Honestly, ignore the political theater and watch three numbers. First, the 10-year Treasury yield. If it spikes violently during his testimony, the bond market is telling you Warsh's QT timeline is way too aggressive.
Okay, that's one.
Second, watch the VIX, the volatility index.
Mm.
A surge there indicates institutional panic is setting in regarding the plumbing.
And the third.
Third, monitor the U.S. dollar index, the DXY. If the dollar surges, it confirms that global liquidity is being aggressively squeezed, which should flash a massive warning light for your international, especially emerging and Australian, market exposures.
The 10-year, the VIX, and the dollar. Let's pull all of this together. Tomorrow morning marks the launch of the QT for rate cuts era. Warsh is attempting to shrink the Fed's balance sheet to drive up long-term rates and anchor inflation, which he believes creates a safe harbor to slash short-term rates and fuel real economic growth.
And during the May transition window, you have to expect serious volatility. Prepare for a stronger dollar that will drain capital from global markets and anticipate heavy pressure on high multiple tech stocks as discount rates rise.
Keep your eyes locked on that $3 trillion reserve threshold. Because if the engine runs out of oil, the overnight lending markets freeze just like they did in 2019. Use value and cyclical stocks as your short-term shield, but whatever you do, do not lose sight of the long-term AI productivity tailwind that the major institutions are banking on for that 8,200 S&P target. It really all comes down to the exact rhetoric Warsh uses tomorrow.
Which leaves us with a critical, kind of lingering question to consider as this new era begins. We've discussed how Warsh believes AI allows for massive economic growth without triggering inflation, right?
Right.
But many economists are currently debating the flip side of that coin. Will this massive AI productivity boom actually force the neutral interest rate, the baseline rate that neither stimulates nor restricts the economy, to structurally rise?
Well, it's fascinating.
If Warsh is right, and AI truly rewires the fundamental capacity of human output, we have to ask, in this hyper-productive, tech-driven economy, are the traditional data points the Fed has relied on for a century to manage liquidity already completely obsolete?
Man, that is a massive structural question. If the old diagnostic tools for the economy are broken, Warsh is stepping in to read a very murky landscape. We'll see exactly how he navigates it starting tomorrow at 10 a.m. Thank you for taking this deep dive with us. Keep your eyes on the data, check your blind spots, and we'll see you next time.